So what are our potential risks? The scenario mentioned previously is basically our greatest risk because you can imagine your capital being trapped in the stock for a long period of time, costing you the opportunity to make better use of your capital when there is a better deal elsewhere. So that is basically what has happened in one of my trades in Johnson & Johnson, J&J. I have bought the stock at a price of 165, that is somewhere around here, just a few days before the ex-dividend date. Initially, I was able to sell a call at 165, and by doing that, it lowers my purchase price to 162.5. That would be somewhere around here. But as you can see, after giving out dividends, stock price just keep dropping sharply for a few days continuously after that. So after selling a few calls at 162.5, this whole period of time from the 5th of March all the way to the 12th of March, this stretch over here, I wasn't able to sell any calls. Until prices continue to rise further up, was I able to sell another call at 162.5 for 1 to 2 weeks after, and then finally was able to exit the entire trade at this period over here. Alright, so from this trade alone, my capital was stuck. In fact, the whole trade takes me 66 days. And from here, you can backtrack the steps that I've taken in selling the calls to ensure that I continue to earn premium while waiting. Alright, and can you imagine what would have happened if we were to execute this trade in March of 2020 last year? During the great steep crash caused by COVID-19, imagine you have entered somewhere around here and getting ready to collect the dividends that is issued during this period. And after getting the dividends, stock prices just fell against you very sharply. Right, so you can imagine during this period, you will not be able to do anything, needless to say, selling any covered calls that can fetch you meaningful premium, and at the same time will not cause you to incur a loss on your initial capital after the sale of your stock and option. Alright, so this would be another period where if you were to execute a trade, you have to be prepared for your capital to be stuck in there for 2 to 3 months. Or if this drags out, it might be even longer. Now, what about stock price dropping and never recover? Well, I would say that the probability of something like this happening would be quite slim because our initial set of screening criteria should have filtered off the weak companies, leaving us with the top dividend paying companies backed with fundamentals and technicals. However, to mitigate some of these risks, here are some actions that you can consider. Remember earlier we said not to utilize margin for this strategy? Because when you use margin to own the shares, you are considered a weak hand. That means when the stock price drops too much, you'll be faced with margin calls and might have to force liquidate your shares at a loss. And also by using margin, and if you end up stuck in the stock for 2 to 3 months, you will need to pay margin interest on the sum you borrowed. This additional cost will bring down our overall profit, and that is not desirable. Another way to lower the risk for yourself will be to only execute this strategy on stocks that you want to own. That way, even when prices stay suppressed for prolonged periods, it is generally not as bad for you because you want to own the stocks anyway, though it still sucks to buy them at a higher price. Now lastly, hardcore traders watching this will scream at me, you need to have a stop loss. Well, you can set one if you are insecure about the trade, perhaps at a distance that is 2 times the dividends that you will be receiving from the stock. But personally, I do not do this because I have rule number 1 and rule number 2 in place. And I'm confident in the stocks that I'm trading this strategy on. So what next? Recall that so far, all this entry and exit, profit and loss that we have been talking about is on your stock position and on your initial capital. So if you have managed to get out without a loss, then congratulations. You have preserved your capital, and what's better is that you have free dividends coming into your account soon. Now with the dividends, reinvest into the stock and start building and compounding your own dividend portfolio. Remember that we want to avoid topping up with our capital when reinvesting. Now with your preserved capital, it's time to start planning your next trade for the next dividend paying stock. And most of the time, you might observe that your capital might have grown a little from the profits of selling the covered calls. Now with these profits, there are a few ways you can utilize them. You can use it to grow your capital so that over time, you have a larger capital to work with to trade either more shares or more expensive stocks. Otherwise, you can also choose to reinvest the profits or use it to top up so that you can reinvest into one whole share if you are restricted from fractional shares trading. Now, if you do this, you'll be able to grow and compound your dividend portfolio at a much faster rate. Alright, and there you have it, the simple and safe dividend capture strategy outlined in full for you over here. Be sure to support the channel by leaving a like and subscribe. Turn on the bell notification so that you can receive first-hand updates on when the next new video is being uploaded. After discussing the strategy in depth, let us go through some of the stocks from my personal watch list that we can potentially execute this strategy on. Alright, so this is my watch list for the dividend capture strategy, and it is just a short list with slightly over 10 stocks to look at. First up, we have none other than AbbVie. I believe you should be clear why this stock is so attractive for the dividend capture strategy by now. Strong fundamentals followed by a high dividend yield as compared to the current trading price. Next up, we have ADP, one of the stocks that belong to the dividend aristocrats and dividend kings category. Alright, the pros of this is that it has stable fundamentals. However, the dividend that it is yielding right now is slightly lacking because of its high stock price. So in order for us to execute this strategy on ADP, we might have to wait for the stock price to retrace a little bit down to perhaps somewhere near the 150 or the 200 moving average. Right now, the dividend yield is currently at 2% or slightly less than 2%. So we will have to wait on this, but nonetheless, something to keep your eyes on. And then we have Bank of America, one of my favorite stock last year when the stock price was still low and it was paying out a dividend of 18 cents per share. The dividends paid has not been changed, and therefore you can expect that with such a huge increase in stock price, it is no longer attractive anymore. Alright, and you might also want to take note that Bank of America is not in the dividend aristocrat and dividend kings group. And this is one of the downside and one of the rule you would have broken if you were to execute the strategy on this stock. But I still traded on Bank of America nonetheless back in 2020 because it was a fundamentally strong stock to me and it was attractive and something that I want to own in my dividend paying portfolio. Next, we have Colgate, ticker symbol CL. Likewise, with the current stock price at $80.70 and with a dividend yield of 45 cents, it is slightly lacking, just slightly below the 2.5% yield that we are looking out for. So once again, you might have to wait for stock prices to come down a little before this stock can give you an attractive dividend yield. And then we have Cisco, a company with flat fundamentals for the revenue, cash flow from operations, and as well as the net income. With the current price at $52.80, close to $53, and a dividend payout of 37 cents per quarter, the current yield is just slightly above our 2.5% criteria. In fact, it is giving us 2.7% a year, so something you can consider on if prices were to continue trading sideways. It will be good if you can retrace back a little by the time the next dividend payout is around the corner. If it goes up, then you might have to calculate again and see if it is an attractive stock to execute the strategy on. And then we have GD, General Dynamics Corp. For this company, it is currently yielding just nice at 2.5%. So if stock prices were to continue rising, then it will not be an attractive candidate anymore. And then we have J&J. Nonetheless, it is still an attractive candidate with a dividend payout of $1.01 and with a price of only 162. So this is definitely another stock that I will execute the strategy on for its next dividend payout. Right, and as with Bank of America, we have JPM. Likewise, this stock has rised up too much. With the current dividend payout of 90 cents, it is no longer attractive at a stock price of 153. And what's more, JPM is also not part of the dividend aristocrat or the dividend kings category. And then we have Kimberly-Clark, ticker symbol KMB. At its current dividend payout and its current price, the yield is at about 3.2%. So definitely attractive and something to look out for when the next dividend payout is around the corner. And then I have LEG up my watch list. LEG is in fact a very attractive stock to execute the strategy on. Although the fundamental is slightly on the weak side, but it is paying 4% dividend yield with a payout amount of 40 cents and a stock price of about $47. But what's bad about this stock is the availability of the options to trade from. As you can see, there is no weekly options available, so it is very hard for us to plan our sales of covered call with the limited expiration dates that is available. So if you want to execute the strategy on this stock, I will foresee that you will have to go on without the covered call portion, just buying and holding the stock. and then selling it when it rises above your initial purchase price. Either that, or you have to sell a far dated covered call and then wait a long time before you can exit the whole position together. So this is definitely not a stock that you can get in and out easily with, so something to bear in mind if you are interested in it. And then we have everyone's favorites, McDonald, ticker symbol MCD. However, the current dividend yield is slightly on the low side of about 2.2%. This is because prices have risen up quite a bit. If prices were to stay at the 206 level, which was the support previously, then perhaps it might be something for you to consider. Up on my watch list, we also have 3M. And 3M, on the other hand, despite the huge rise in the stock price, it is still an attractive candidate. At a price of about $200 and a dividend payout of 148, close to 150, the dividend yield is definitely more than 2.5%. And if we were to look at the long-term outlook of the stock, it is definitely on a long-term uptrend. Despite prices declining for the past 2 to 3 years or 2.5 years, you can see that prices have broken out of the downwards channel, and that should signify higher prices from here on. So something to consider if you are interested in having 3M in your dividend portfolio. Next, I have Merck, ticker symbol MRK, another one of my personal favorite. Take note that this is not part of the Dividend King or Aristocrat group. However, their dividend payout is very attractive at 65 cents and a stock price of only about $78 or close to $80. The current dividend yield is at about 3%, right? So very attractive. And personally, I have faith in the company. All right, and coming to the end, the second last stock that I have is PepsiCo, ticker symbol PEP. It is having a current dividend yield of 2.7%, so still attractive if prices can maintain at this level. And finally, we have Procter & Gamble, ticker symbol PG. With its current price now and the dividend payout, it is having a current dividend yield of exactly 2.5%. Another attractive and fundamentally strong stock for you to consider in your dividend portfolio. Alright, so that's all I have for you guys, and I hope that they will serve as a good head start on your journey to build your own dividend portfolio. Let me know in the comments below what you think of the entire strategy so far. What are the pros and cons of the strategy? If you'd like to receive more updates from me on when I enter and exit my positions using the dividend capture strategy, then feel free to join our Telegram community chat group using this link over here. Thank you so much for watching, and I'll see you in the next video.